You know, something fundamental is changing in the crypto markets. And I'm not talking about a shift in sentiment. This is a shift in the very structure of things. Because, well, the big money is officially here. Just take a look at this. This is the cumulative spot trading volume for Bitcoin in 2024. I mean, it's already completely dwarfing previous years. We're talking about a massive surge of capital. And it's doing more than just moving prices. It's reshaping the entire landscape. But hang on. This isn't just, a few more people deciding to buy some crypto. The sheer scale and the speed of it, well, it suggests something else is going on. So what are we really looking at here? Is this just organic growth, a sign that crypto's finally hit the mainstream? Or is it something more deliberate, a structured entry, almost like a redesign of the market's architecture from the inside out?
And that's really the core question we're going to dig into today. We're going to look at the mechanics and, more importantly, the consequences of institutional crypto adoption. Because here's the thing you have to understand. When institutions enter a market, they don't just invest in it, they fundamentally change the system itself. Okay, so before we dive in, just a quick note for everyone. This explainer, here on Blockspawn's Funds, is created purely for educational and informational purposes. It is absolutely not financial or investment advice. All right, so let's get into it. We've got a whole new class of investor arriving on the scene, and you need to know they aren't just here to play the game. They are rewriting the rules. So first off, let's get on the same page. What do we even mean by institutional adoption? This isn't just about a few companies adding Bitcoin to their balance sheets. No. We're talking about the large-scale entry of the really big financial players, hedge funds, asset managers, major banks, and those all-important prime brokers who handle things like lending and trade execution. They're all piling in, and they're bringing immense capital and incredibly sophisticated strategies right into the heart of the digital asset space. And let me be clear, this is not some theoretical trend we're talking about for the future. It's happening right now. As you can see from this chart, spot Bitcoin ETFs, which are a key product for institutions, are a massive driver of this record-breaking volume. The institutional era? It's already here, and it's reshaping the market structure as we speak.
Okay, so here's where it gets really interesting. It's how these institutions invest, because they operate on a completely different level from your average retail user. They don't just buy crypto, they integrate it. Let's just do a quick comparison to see what I mean. On one hand, you have retail investors. We're typically making smaller trades on public exchanges, and let's be honest, our decisions can be a little emotion-driven. Now, on the other hand, you have the institutions. They're executing enormous block trades, often privately through what are called over-the-counter or OTC desks. And their decisions, they're all based on complex, structured strategies with this relentless focus on risk management and compliance. It's like they're playing two completely different sports on the same field. And to operate in their world, they have this whole specialized toolkit. This includes things like spot ETFs, right? Those give their clients regulated and super easy exposure. They use those OTC desks to move massive orders without sending the market into a panic. They rely on prime brokers for all their financing. And maybe most importantly, secure custody solutions. That's totally non-negotiable when you're safeguarding billions of dollars in assets. We're talking about industrial-grade financial machinery here. So the big question is, what happens when all of this industrial-grade machinery gets deployed at scale? Well, it does a lot more than just add money to the market. It completely transforms the very structure of how trading even works. Investing.com put it pretty well. They said, "We've moved away from those chaotic, retail-driven cycles we saw in the past. Today's market is really defined by these huge, coordinated capital flows coming from institutions." So the really crucial thing to get our heads around is, what does that actually do to the market? Okay, so the first major effect is that the market liquidity gets way deeper. This chart here shows market depth over time. Now, what that really means is the market's ability to soak up huge orders without the price going completely haywire. As these institutions pour in all this capital, the market just gets deeper. It becomes more robust and way less likely to have those crazy price swings just because one person made a big trade. And this right here,
This illustrates the result perfectly. What happens when you get deeper liquidity? You get reduced volatility. You can see it clear as day. Bitcoin's one-month volatility has been trending down, 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 even hitting historic lows while trading activity is going up. That kind of stability, that's a classic sign of a maturing asset class.
But, and this is a really big but, there's always a trade-off. This new stability, this new efficiency, it comes at a price. And that price might just be one of the original core ideas of crypto itself, decentralization. Get a load of this number. It's pretty staggering. According to the European Systemic Risk Board, just 3 custodians hold 71% of all the assets for physically backed crypto investment products. Let that sink in for a second. A huge, huge chunk of the institutional market is relying on a tiny, tiny handful of players.
And this is that double-edged sword I was talking about. One source put it perfectly. Concentrating all this activity, yeah, it improves speed and efficiency, but it also creates this critical dependency on just a few centralized companies. And what that does is introduce a whole new kind of systemic risk. The risk that if one of these huge players fails, it could set off a domino effect across the entire market.
And here's the visual proof. You don't have to just take my word for it. This chart breaks down the custodian providers for these crypto investment products. And you can see it right away, can't you? A few of these bars, especially Coinbase, they just tower over everyone else. This is what a concentration of control looks like in a chart.
Now, this concentration problem isn't just limited to those third-party custodians. It actually extends to the exchanges themselves. I mean, look at the centralized exchange market. Binance, by itself, holds over 72% of user assets. It's basically become systemic infrastructure for the whole market.
So, what does all this add up to?
What we're really witnessing is the birth of a whole new crypto financial system. And yeah, it's more efficient, it's more stable, but it's also way more interconnected with traditional finance. And with those connections come entirely new kinds of risk.
So here's the trade-off laid out plain and simple. The pros, they're obvious. You get more liquidity, more stability, and way more mainstream credibility. But the cons, well, they're pretty serious. You've got this heavy concentration of control and influence. You have new systemic risks, where one failure could cause a cascade. And you get a higher correlation with traditional markets, which basically means crypto starts acting a lot more like stocks, reducing its power as a way to diversify your portfolio.
And this quote, I think, just perfectly captures the delicate balance of this new era we're in. Yeah, the market is maturing, it's becoming more efficient, more integrated, but that very interconnectedness, that's what could also make it more fragile and more vulnerable to shocks coming from the traditional financial world.
Which, brings us to our final and maybe most important question. The market is becoming more stable. It's more efficient. It's definitely more palatable to the mainstream. But in trading away some of its decentralized chaos for all this centralized efficiency, is it still really crypto? Is it still embodying that original spirit that started this whole thing?
And that, right there, is the crucial question we're all left with as this transformation keeps rolling on.